Bismillahirrahmanirrahim. Assalamu alaikum. Viewers, you are welcome to my YouTube channel, Finance Specialist. Viewers, in this video, I will show you with the help of one example that by using information given in the stockholders equity section of the balance sheet, how we can calculate preferred shares outstanding, their annual dividend requirements, common shares or ordinary shares outstanding, their average issuance price, legal capital, total paid in capital, and the book value per share concept. Viewers, if you are new to this channel, you are requested to subscribe to it so that you will be notified for the upcoming videos on some other topics such as stock split and treasury stock transactions. Let's start with our discussion. Viewers, as you can see, there is a scenario. It is a stockholder equity section which has been extracted from one of the balance sheets of a company. Let's assume that we have a hypothetical company XYZ Corporation. In this stockholders equity, you can see that it mentions that there is a preferred stock or a preferred share which has annual dividend $6 and the face value of the share is 100, and this share is callable at $102 per share, meaning that the company can buy back its share at a price of $102 per share, and number of shares which are authorized are 200,000, and the amount collected, as of now we do not know that how many preferred stock or preferred shares have been issued, but whatever they have issued, the money they have collected is $12 million. Similarly, common stock or common share which has a face value or a par value $5, 5 million shares are authorized, and again we do not know that how many shares they have issued, but whatever they have issued, they have received $14 million cash. Now the next, you can see the next heading, it mentions additional paid in capital. Additional paid in capital means that sometimes companies, they sell their stock at a price which is more than their face value. So when companies can sell their stock at a price more than their face value, because of the company's standing in the market. If company is a good company and it is enjoying its reputation in the market, it has a good reputation, so the company can claim some extra premium. So here it mentions that the extra premium which company has received after selling its preferred stock, it is $360,000, and similarly the extra premium which the company has collected after selling common stock is 30.8 million, and the retained earnings, like before coming on to the retained earnings, if you add the additional paid in capital amount, so you can see that the extra amount which company has received after selling preferred stock or a common stock, so when we add it together, it will give us 31.16 million. Then comes the retained earnings. Retained earning means over a period of time when company makes profit, it will distribute part of it, and the rest of the profit it will keep with itself for its future requirements. So over the period of time, this profit which company has retained itself, it will grow, it will accumulate. So that retained portion of the profit is called as retained earnings. So here we are having the retained earnings 26.6 million, and when we add all these values such as the money collected, the amount collected after selling preferred stock, the actual amount, similarly the amount collected after selling common stock, the extra amount or premium which company has collected, in addition to it if there is any retained earning, so it will give us total stockholders equity. So now let's move on to the requirements. As you can see here that the first requirement, it says how many shares of preferred stock have been issued. So first thing we need to calculate the total number of preferred stock shares which are outstanding. So it is quite simple. We have this value. So the company has received $12 million and the face value of a share is $100. So by simply dividing the overall amount by its par value, so it will give us number of shares outstanding. What type of shares? It is preferred stock, obviously. So if you look at here, what I have done is that this is the total par value, which is 12 million, and this value is divided by the par value per share, which is 100. So this will give us 120,000 shares. So after dividing 1200,000 by 100, it will give us total number of preferred stock outstanding. So this is how we can calculate total number of preferred stock outstanding. The next requirement is what is the total annual dividend requirements on the outstanding preferred stock. Since we have already calculated that we have 120,000 shares which are outstanding or in the market, so we can easily calculate dividend requirements. So here you can see in the stockholders equity section that each preferred stock is having a dividend of $6. So on each share the company will pay $6 dividend. Since we know the total number of shares outstanding, so we can multiply the per share dividend with outstanding number of shares. So this will give us $720,000 dividend amount. So this is the second requirement. The third requirement, it says that how many shares of common stock have been issued. So common stock we are having, you can see that the par value is $5 and 5 million shares are authorized, and the total amount received after selling the common stock, which is 14 million. So by simply dividing 14 million by this $5, which is a par value, it will give us common stock outstanding. So here you can see that number of common stock issued 14 million, it is a total par value, and it is divided by $5 par value per share. So this will give us 2800,000 shares outstanding. So this is how we can calculate common stock outstanding. The fourth requirement is what was the average price per share received by the corporation for its common stock. As I said earlier that the companies normally they sell their stock at a price which is more than its par value. It is possible only if the company is enjoying good reputation in the market. And here we can see that the actual amount which company has received is 14 million, and also the company has collected some additional paid-in capital which is 30.8 million. So it means 14 million and 30.8 million, these two amounts are basically received after selling common stock. So when we add these two amounts and then we divide them by total number of shares outstanding, so it will give us the average price. So let's have a look here. Par value of a common share which I have taken this amount, 14 million from the stockholders equity. Then comes additional paid in capital. Again, I've taken this amount from the same stockholders equity section, and after adding these two, we will get 44.8 million. So this is basically the total amount which company has collected after selling its common stock. Now, we have already calculated the number of common shares issued or outstanding in part 3, which is 2.8 million. So when we divide the total issue price of common shares by common shares outstanding, so it will give us the average issue price per share. So the average price will become 44.8 million divided by 2.8 billion. So it will give us, the average price will come $16 per share. Similarly, the fifth requirement, it says what is the amount of legal capital. So legal capital is basically the sum of the actual capital which company has received irrespective of premium. So from the stockholders equity section, we can see easily that preferred stock which company has sold, it has collected $12 million, and on a common stock the company has received $14 million. When we add 12 million and 14 million, so it will give us legal capital. So let's have a look here. The amount of legal capital, we are having preferred stock which is 12 million plus the common shares amount which is 14 million. When we add these two amounts together, so it will give us 26 million, which is the legal capital. When it comes to total paid in capital, so total paid in capital, basically it is the sum of legal capital plus additional paid in capital. So additional paid in capital, you can see over here that preferred stock, the company has collected $360,000 extra premium, and on a common stock the company has collected 30.8 million. When we add both the amounts together, so it will give us 31.16 million. So this is additional paid in capital. When we talk about total paid in capital, so it is a sum of legal capital plus additional paid in capital. So legal capital we have already calculated 26 million plus this additional paid in capital, I've taken it from the stockholders equity section. So when we add both these amounts together, so it will give us total paid in capital, which is 57.16 million. The last concept of the requirement is to calculate the book value per share of common stock, and we are assuming that there is no dividends in arrears. The calculation process is quite simple. Viewers, when we need to calculate the book value per share of common stock, we start from total stockholders equity. As you can see that the total stockholders equity value is 59.84 million. Here it comes, and this I have taken from here, 59.84 million. From this amount, we need to subtract the call price of preferred shares, as it is given in the same equity section that the call price of a preferred share is 102, and we have already calculated that number of preferred stock which are outstanding. So we will assume that if a company call back all the preferred shares, so how much money it will have to pay. So simply what we'll do, we will multiply 120,000 and this one with the call price, so it will give us the total amount which refers to the claim of preferred shareholders. So after subtracting this amount from the total stockholders equity, after subtracting the preferred shareholders amount, the resultant amount, it will be the equity of common stockholders. This is the equity of common stockholders. So common stock equity, we need to divide it by number of common shares outstanding, which we have already calculated in the previous requirements. So after dividing the common stockholders equity by number of common shares outstanding, so it will give us the book value per share. The point to note here is that book value per share is always calculated by using common shares outstanding. And before calculating this, we need to subtract the call price of a preferred shares plus if there is any dividend which are in arrears. Since we had one assumption that there is no dividend in arrears, so therefore I have not mentioned this amount. So even here in our case it is 0. So the idea to calculate the book value per share is first total capital, total stockholders equity minus call price of all preferred shares outstanding, and it will give us equity of common stockholders, and this amount we need to divide by number of common shares outstanding, and then finally it will give us the book value per share, and in our case it is $17. So viewers, with the help of this example, what we have learned these 7 requirements. Number 1, calculation of outstanding shares of preferred stock. Similarly, annual dividend requirements on the outstanding preferred stock, and calculation of shares of common stock, and also the average price per share, the issuance price, average issuance price of the common stock, also the amount of legal capital and total paid in capital, followed by the book value per share of common stock. So viewers, I hope you would have understood all these measures. Thanks for watching. If you have not subscribed to this channel, you are requested to subscribe to it to get yourself notified for the future videos which are in the pipeline. Share your thoughts, suggestions in the comment section. Stay blessed. Thank you very much.